Home prices in America were supposed to be unstoppable. For years, the narrative never changed. Bidding wars, instant offers, cash buyers swooping in above asking price, making home ownership feel like a fantasy reserved for the ultra-wealthy or the incredibly lucky. Sellers held all the cards. Buyers bent over backward just to get noticed. Real estate became less about finding a place to live and more about surviving a financial gladiator arena. But something fundamental has shifted in 2026. The power dynamic that seemed carved in stone is cracking wide open, and the everyday buyers they counted on have finally tapped out. If you've been priced out, ignored, or outbid for the past few years, what's happening right now might just be the opening you've been waiting for. Today, we're counting down 14 real estate markets where prices are absolutely plunging in 2026. Make sure to hit subscribe in the next 10 seconds because we're diving deep into the data, the drama, and what it all means for the future of American housing. Let's get into it. Number 14. Boca Raton, Florida. Boca Raton spent the last few years riding an absolute tidal wave of demand. Retirees with deep pockets poured in from the Northeast. Wealthy families fleeing lockdowns grabbed waterfront properties without blinking. Investors treated the city like a gold mine, certain that South Florida's momentum would never stall. But 2026 has delivered a wake-up call nobody wanted to hear. Home prices have tumbled roughly 9% year over year, and inventory is piling up faster than agents can handle. Luxury estates that used to vanish within days are now collecting dust on listing sites for months. Number 13. Nashville, Tennessee. Nashville exploded into the national spotlight as the it city of the South. Country music, hot chicken, and a booming job market turned it into a magnet for young professionals and corporate relocations. For a while, it genuinely felt like the city could do no wrong. Developers raced to keep up, constructing sleek condos and sprawling subdivisions across Davidson County and beyond. Number 12. Denver, Colorado. Denver's housing market spent years being held up as a model of stability and steady appreciation. Nestled against the Rockies, with a strong economy and an endless stream of outdoor enthusiasts, the city felt like a safe bet for buyers and investors alike. But 2026 is proving that even the most stable markets have breaking points. Home prices have slipped roughly 7%, and days on market have nearly doubled compared to last year. The slowdown is hitting hardest in the suburbs. Aurora, Lakewood, and Highlands Ranch are seeing listings pile up with far fewer buyers stepping forward. Number 11. Charlotte, North Carolina. Charlotte became the Southeast's corporate darling, attracting banking giants, tech firms, and a steady wave of residents fleeing higher-cost metros. For years, it felt like the city's growth was inevitable. New neighborhoods sprouted across Mecklenburg County and into surrounding suburbs. Home prices climbed smoothly, and the market hummed along with confidence. But 2026 has brought a sharp reversal. Prices have fallen about 6%, and inventory is starting to stack up in areas that used to move quickly. South Charlotte, University City, and even parts of Uptown are seeing homes linger far longer than sellers anticipated. The slowdown stems from a combination of oversupply and cooling migration. Developers built thousands of single-family homes and townhomes, banking on the belief that people would keep flooding in. But the wave has slowed. Remote work made Charlotte appealing during the pandemic, but as companies call employees back to the office, some of those transplants are reconsidering. The job market, while still solid, isn't expanding at the breakneck pace it once was. Hiring freezes and layoffs in finance and tech have made buyers more cautious. Younger professionals who might have stretched to buy are now choosing to rent or wait, unsure if prices will drop further. Sellers who assumed they'd make a quick profit are realizing the market has shifted. Homes that would have sparked bidding wars 2 years ago are now sitting with minimal interest, forcing price reductions and concessions. Investors who treated Charlotte like a sure thing are also stepping back, spooked by tighter margins and rising costs. In 2026, Charlotte is still growing, but the easy gains are over. The market that once rewarded every risk is now demanding patience, strategy, and realistic expectations. Number 10. Raleigh, North Carolina. Raleigh spent years being praised as one of the country's most balanced, sustainable housing markets. Strong job growth, top-tier universities, and a steady influx of young professionals made it feel like the ideal place to buy. But balance is fragile, and in 2026, Raleigh is tipping. Home prices have dropped roughly 7%, and inventory levels are climbing across Wake County and into the suburbs. Cary, Apex, and Holly Springs, once nearly impossible markets to crack, are now filled with listings that sit untouched for weeks. The issue is twofold: oversupply and shifting priorities. Builders raced to meet demand during the boom, flooding the market with new construction, but that demand has cooled as remote work loses its grip and buyers grow more selective. Many who move to Raleigh for tech or research jobs are reconsidering as companies tighten budgets and hiring slows. At the same time, affordability is becoming a real barrier. Home prices that felt reasonable compared to the coasts are now stretching local wages to the breaking point. First-time buyers are walking away, unable to compete with the costs of down payments, closing fees, and monthly payments at elevated interest rates. Investors are also retreating. The rental market in Raleigh, once rock solid, is softening as supply outpaces tenant demand. Properties that used to rent instantly are sitting vacant, forcing landlords to drop prices and offer incentives. Even short-term rental operators are feeling the squeeze as regulations tighten and profitability shrinks. Raleigh's long-term fundamentals remain strong, but the market is going through a painful reset. The city that epitomized smart, steady growth is now facing the reality that even the best markets can overheat, and when they do, the correction is unavoidable. Number 9. Salt Lake City, Utah. Salt Lake City became a phenomenon during the pandemic, drawing remote workers, outdoor enthusiasts, and families seeking space and mountain views. Home prices rocketed upward, and the market felt unstoppable. Builders scrambled to keep up, constructing subdivisions across the valley and into surrounding counties. But 2026 has brought the momentum to a sudden, jarring halt. Prices have fallen about 10%, and homes are sitting on the market far longer than anyone predicted. Neighborhoods in West Valley, Draper, and Harriman that used to see instant offers are now watching listings go stale. The primary driver of the decline is oversupply. Developers built with the assumption that demand would remain sky-high indefinitely. Instead, migration has slowed, and the buyers who fueled the boom have largely moved on. Remote work, the engine behind so much of Salt Lake's growth, is fading as companies mandate returns to the office. Workers who relocated for lifestyle are now facing pressure to move back or risk losing their jobs. At the same time, affordability has become a major obstacle. Prices climbed so quickly that locals were priced out, and transplants are realizing that Utah's cost of living is no longer the bargain it once was. Rising property taxes, expensive utilities, and the growing cost of homeownership are making buyers think twice. Investors who jumped into the market are also retreating. Single-family rentals that promised steady returns are sitting vacant or generating far less income than projected. The combination of higher interest rates and softer demand has killed the easy profits. Salt Lake City's natural beauty and quality of life will always attract people, but in 2026, that's not enough to support the prices sellers are asking. The correction is real, and the market is adjusting to a new, more grounded reality. Number 8. Tampa, Florida. Tampa's real estate surge felt relentless. A mix of retirees, remote workers, and investors turned the city into one of the hottest markets in the country. Prices soared, inventory vanished, and sellers enjoyed a level of control that seemed unshakable. But 2026 has flipped the script entirely. Home prices have dropped about 11%, and the market is flooded with listings that aren't moving. Neighborhoods in South Tampa, West Chase, and New Tampa are seeing properties sit for months, something that would have been unthinkable just 2 years ago. The collapse is being driven by a perfect storm of challenges. Insurance costs have become crushing, with premiums doubling or tripling as hurricane risk intensifies. Property taxes are climbing sharply, and HOA fees are spiking as older buildings scramble to meet updated safety requirements. For many buyers, the numbers simply don't add up anymore. Retirees on fixed incomes are reconsidering whether Florida makes financial sense. The dream of waterfront living has been replaced by the anxiety of endless rising costs. Even younger buyers, who might have stretched to afford a home during the boom, are walking away, spooked by the financial risks and climate concerns. Investors are also pulling back in droves. Short-term rental regulations have tightened, and the profitability that once made Tampa attractive has evaporated. Properties that used to generate strong cash flow are now bleeding money, and owners are selling at a loss just to escape. International buyers, who were a huge part of Tampa's market, have largely disappeared, unnerved by political instability and the growing recognition that Florida's real estate risks are real and escalating. In 2026, Tampa is a textbook example of what happens when a market climbs too fast without a sustainable foundation. The correction is brutal, and the market still hasn't found its floor. Number 7. Portland, Oregon. Portland's housing market was supposed to be insulated by scarcity and steady demand. A combination of strict growth boundaries, limited inventory, and a steady stream of West Coast transplants kept prices elevated for years. But 2026 has shattered that sense of security. Home prices have tumbled roughly 9%, and inventory is starting to pile up across the metro. Neighborhoods in southeast Portland, Beaverton, and Hillsborough that used to move quickly are now seeing homes sit untouched for months. The slowdown is being driven by a mix of factors. Remote work, which brought a wave of California transplants during the pandemic, has faded. Workers who moved to Portland for lifestyle are now being pulled back to offices in the Bay Area or Los Angeles, and many are selling and leaving. At the same time, Portland's reputation has taken a hit. Concerns about homelessness, safety, and quality of life have made buyers more hesitant. The city that once symbolized quirky charm and livability now carries a perception problem that's hard to shake. Economic uncertainty is compounding the issue. Job growth has stalled, wages aren't keeping pace with the cost of living, and younger buyers are either moving to cheaper cities or giving up on home ownership altogether. Investors who bought during the boom are now stuck. Rental demand has softened, vacancy rates are climbing, and the cash flow that justified high purchase prices has disappeared. Sellers who expected to cash out are instead facing tough choices: drop the price and take a loss, or hold on and hope the market rebounds. But hope isn't a strategy, and the longer homes sit, the more desperate sellers become. In 2026, Portland is learning that even markets with natural constraints can fall when the fundamentals shift. The city's long-term appeal remains, but the market is going through a painful recalibration that's far from over. Number 6. Sacramento, California. Sacramento was supposed to be California's escape valve, the affordable alternative to the Bay Area's chaos. For years, it played that role perfectly. Families and remote workers flooded in, driving prices upward and making the market feel unstoppable. Builders responded with optimism, constructing thousands of new homes across Elk Grove, Roseville, and Natimas. But by 2026, the script has flipped. Home prices have fallen about 12%, and inventory is surging. Properties that used to sell within days are now languishing for months, often with multiple price cuts. The primary issue is that Sacramento's appeal was built on affordability, and that advantage has evaporated. Prices climbed so aggressively during the pandemic that the city is no longer the bargain it once was. Buyers who might have stretched to escape the Bay Area are now questioning whether the move makes sense, especially as remote work fades and commutes become necessary again. Job growth in Sacramento has also slowed. The state government, a major employer, has tightened budgets, and private sector expansion has cooled. Without strong wage growth, buyers are struggling to keep up with elevated home prices and rising interest rates. Investors are retreating too. The rental market, once tight and profitable, has softened as supply outpaces demand. Single-family rental operators are finding it harder to fill properties, and those who bought at peak prices are watching their equity disappear. New construction is compounding the problem. Builders who launched projects during the boom are now completing them in a market with far weaker demand, leading to aggressive discounting and fire sales. Sacramento's story is a familiar one, a city that rose too fast on a single narrative and is now paying the price as that narrative unravels. The correction is real, and the market is still searching for solid ground. Number 5. Jacksonville, Florida. Jacksonville marketed itself as Florida's hidden gem, offering beach access, affordability, and room to grow. For a while, that pitch worked brilliantly. Remote workers and retirees poured in, driving prices upward and creating a seller's market that felt unshakable. But 2026 has exposed the cracks in that foundation. Home prices have plunged about 10%, and inventory is stacking up across Duval County and into the suburbs. Neighborhoods in Ponte Vedra, Southside, and Arlington are seeing homes sit for months with minimal interest. The collapse is being driven by the same forces hitting the rest of Florida: skyrocketing insurance premiums, rising property taxes, and growing concerns about climate risk. Buyers who were once willing to overlook those issues are now walking away, unwilling to take on the financial burden. Retirees, who made up a huge portion of Jacksonville's buyer pool, are reconsidering whether Florida makes sense. The combination of heat, hurricanes, and rising costs has dimmed the appeal of the Sunshine State retirement dream. Younger buyers are also stepping back, spooked by the long-term risks and the realization that affordability was temporary. Investors are bailing out in droves. Short-term rental operators who expected strong returns are instead dealing with tighter regulations, higher costs, and weaker demand. Properties that used to generate cash flow are now sitting vacant, and owners are selling at losses just to escape. The new construction market is saturated. Builders overestimated demand and are now stuck with completed homes they can't sell at the prices they need. Discounts, incentives, and desperate marketing have become the norm. Jacksonville's rapid rise made it feel like a safe bet. But in 2026, it's a stark reminder that no market is immune when the fundamentals shift. The correction is deep, and the recovery won't be quick. Number 4. Las Vegas, Nevada. Las Vegas has always thrived on risk, but in 2026 the gamble isn't paying off for homeowners. After years of breakneck growth fueled by California transplants and investor speculation, the market has crashed hard. Prices have fallen about 13%, and homes are sitting unsold for months across the valley. Neighborhoods in Henderson, Summerlin, and North Las Vegas that used to see bidding wars are now filled with price cuts and desperation. The core problem is oversupply. Developers built with the assumption that migration and demand would continue indefinitely. Instead, the wave has stopped. Remote work brought a surge of buyers during the pandemic. But as companies call workers back, many are reconsidering whether Las Vegas is where they want to stay. The city's economy, heavily reliant on tourism and hospitality, remains shaky. Job growth is sluggish, wages are stagnant, and the service workers who keep the city running can't afford the homes that were built during the boom. Investors who treated Las Vegas like easy money are now stuck. The short-term rental market, once wildly profitable, has been gutted by oversupply and tighter regulations. Properties that used to book solid are now sitting empty, draining cash every month. Single-family rental operators are faring no better, with vacancy rates climbing and rental income falling. Builders are slashing prices on new construction, trying desperately to move inventory before the market deteriorates further. Entire subdivisions are offering five-figure incentives, upgraded appliances, and paid closing costs just to attract buyers. Las Vegas has seen crashes before, and the echoes of 2008 are impossible to ignore. The same speculative frenzy, the same overbuilding, the same painful correction. In 2026, the house is winning again, and it's not the homeowners holding the chips. Number 3. Tucson, Arizona. Tucson quietly became one of Arizona's hottest markets during the pandemic, attracting retirees, remote workers, and investors looking for affordability and desert charm. Prices surged, inventory vanished, and the market felt like it had finally arrived. But 2026 has brought a reckoning. Home prices have dropped about 11%, and the market is flooded with listings that aren't moving. Neighborhoods in Oro Valley, Marana, and the Catalina foothills are seeing homes sit for months, often with multiple price reductions. The issue is that Tucson's growth was built on a narrow foundation: affordability. As prices climbed, that advantage disappeared. The city is no longer cheap compared to other Sunbelt markets, and buyers are questioning whether the heat, limited job market, and infrastructure challenges are worth the cost. Migration has slowed significantly. Remote workers who moved during the pandemic are either being called back to offices or choosing different cities with better amenities and opportunities. Retirees are also pulling back, concerned about healthcare access, extreme heat, and the rising cost of living. Builders overshot demand in a major way. Subdivisions that were greenlit during the boom are now completing in a market with far fewer buyers. New homes are sitting unsold, and builders are offering deep discounts, paid upgrades, and desperate incentives. Investors are retreating as well. Rental demand has softened, and properties that used to generate steady income are now struggling to find tenants. The combination of higher interest rates, rising insurance costs, and weaker cash flow has killed the investment case. Tucson's long-term appeal remains for those who love the desert and slower pace, but in 2026, the market is going through a painful reset. Prices that climbed on hype are now falling back to reality, and the adjustment is far from over. Number 2. Phoenix, Arizona. Phoenix became the face of the Sunbelt boom, a city that seemed destined to grow forever. Families from California, the Midwest, and beyond flooded in, driving prices to record levels. Developers couldn't build fast enough, and the market felt like a money-printing machine. But 2026 has delivered a brutal correction. Home prices have plummeted roughly 14%, and inventory is piling up across the metro. Neighborhoods in Chandler, Gilbert, Mesa, and Scottsdale are drowning in unsold homes. The oversupply is staggering. More than 40,000 new homes have hit the market in the past year alone, far more than the city's population growth can support. Builders overestimated demand, and now they're stuck with completed properties they can't move without slashing prices. The migration wave that powered Phoenix has dried up. Remote work is fading, job growth has stalled, and the cost of living has climbed to the point where the city no longer feels like a bargain. Buyers who moved for affordability are realizing that Phoenix has become just as expensive as the places they left, but with extreme heat and limited water resources. Investors are fleeing. The single-family rental market that once promised easy returns is now plagued by vacancies and declining rents. Properties that used to lease instantly are sitting empty, and owners are selling at losses to avoid further damage. Insurance costs, property taxes, and HOA fees have all surged, compressing margins to nothing. New construction discounts are everywhere. Builders are offering $30,000, $40,000, even $50,000 off list prices, plus paid closing costs and rate buydowns, just to generate interest. Phoenix's collapse is a textbook case of speculation gone wrong. The city that climbed the fastest is now falling the hardest, and the bottom is still nowhere in sight. Number 1. Austin, Texas. At the very top of the list is Austin, the city that became the symbol of the pandemic real estate boom, and is now the poster child for its collapse. Prices have cratered by a staggering 16%, the steepest decline of any major metro in the country. Homes that sold for $800,000 in 2022 are now struggling to find buyers at $670,000. Inventory has exploded, and properties are sitting on the market for months, sometimes half a year, with no movement. Austin's downfall is a story of miscalculation on every level. The city marketed itself as the next Silicon Valley, and for a brief moment, it looked like that might be true. Tech giants opened offices, startups flooded in, and venture capital poured into the city. Developers responded by building thousands of luxury homes, convinced that high-income transplants would keep arriving forever. But the tech boom turned into a bust almost overnight. Layoffs gutted the very workforce that sustained Austin's housing market. Companies that relocated with fanfare are now quietly downsizing or leaving altogether. The high earners who could afford $3,000 homes have either lost their jobs or moved to cheaper cities. What's left is a city with far more supply than it can possibly absorb. Entire master-planned communities sit partially empty. Luxury subdivisions in areas like Dripping Springs, Cedar Park, and Pflugerville are filled with for-sale signs and desperate sellers. Builders are slashing prices, offering absurd incentives, and still struggling to move inventory. Investors who piled into Austin expecting quick returns are now trapped. Rental demand has collapsed as the population of high-income renters vanished. Properties that were supposed to generate cash flow are hemorrhaging money, and selling means taking devastating losses. Even locals who bought hoping to build equity are now underwater, owing more than their homes are worth. Austin's collapse is more than a market correction. It's a complete unraveling of the narrative that drove the city's growth. The place that rose the fastest, climbed the highest, and captured the most attention is now falling harder than anywhere else in America. In 2026, Austin is the ultimate cautionary tale about what happens when hype, speculation, and overbuilding collide with reality. The real estate crash of 2026 isn't happening in a vacuum. These 14 markets are symptoms of a much larger shift, a national reckoning with affordability, speculation, and the limits of endless growth. For years, buyers were told that prices only go up, that real estate is always a safe bet, that missing out means losing forever. But markets don't move in straight lines, and corrections are inevitable. What we're seeing now is the price of irrational exuberance. Developers built too much, investors speculated too aggressively, and buyers were stretched beyond their limits. Now, the market is resetting, painfully and unevenly, but unavoidably. For sellers, this is a moment of hard choices. Hold out and hope for a rebound, or cut losses and move on. For buyers, it's a rare window of opportunity, a chance to finally negotiate, to have options, to buy without competing against 10 other offers. But it's also a reminder that timing matters, and no market stays hot or cold forever. If this breakdown gave you a new perspective on where real estate is headed, make sure you're subscribed and notifications are on, because the housing market is shifting faster than ever, and we'll be here tracking every move. The crash is real. The question is, what comes next?